Hello dear students, how's the preparation going on? I, Professor Aagam Dalal, on behalf of JK classes, welcomes you all. Now, friends, why we have met today? If you know, in Inter CA paper number 4A, that is direct text, whatever you have studied in your classroom, in your lectures, are fully amended only. All the amendments are covered within that lecture. However, recently, ICI has issued one statutory amendment PDF on your Board of Studies portal, which includes two amendments. In that, one is a one-liner amendment only, one is little big amendment that was not there in ICI module. But recently ICI has added in your syllabus, which will be applicable in your November 21 exams, which is now going to be held in December. Many students have asked me the query and I have said that you just continue reading whatever is there in the notes, whatever is there in JKSC notes, because this is totally a different amendment, which is not changing anything, which is just adding one more concept in your syllabus. Now, it is from the chapter salaries. Okay. I have prepared one PDF over here covering some examples on this amendment and some easy words for this amendments, which you will get in this link itself of this YouTube video, which you can download it from this link. Now moving towards the amendment without wasting the time. There was a point you must have studied in the lectures. Let me go to the history before that. If you see, whenever an employer is contributing in recognized provident fund, that we can call it RPF, recognized provident fund, you know that up to 12% of the salary of employee, that amount will be exempt. So what is the exemption given? Up to 12% of the salary. And here, what is the meaning of the word salary? It is basic plus DA, which is percentage forming part of retirement benefit, plus commission, percentage of turnover. One more fund is there known as NPS, National Pension Scheme. You must be aware that even employer contribute in this National Pension Scheme also. Whatever employer contributes in this National Pension Scheme, as per 80 CCD subsection 2, first it has to be added in your income of salaries as a perquisite. But then after gross total income, under section 80 CCD subsection 2, you get a deduction, and the deduction is up to 10% of your salary. And here what is the meaning of salary? Basic plus DA percentage, that's it. And if central government is your employer, then instead of 10%, exemption, that is deduction, will be 14% of the salary. Are you aware about this? Yes or no? Yes. One third fund is also there, superannuation fund. People, are you aware about this or not? Superannuation fund. Even employer contributes in this fund also. And what is the exemption available for that? Up to rupees 1,50,000 per annum. Now what was happening is, many big salaried persons who is having huge salary, lakhs and lakhs of rupees, they were taking more contribution in that RPF, NPF superannuation fund, claiming huge exemptions and huge deductions. Government was not in a favor to give such a huge exemption and deduction to them. And that's why what they said, keep these exemptions as it is. It will be as it is. No difference in it. No amendment in that. But as per section 17 clause 2, they said, now whosoever contribute in your RPF plus NPS plus superannuation fund combinedly, means let's say I am an employee, my employer is contributing in my recognized provident fund, he is also contributing in my national pension scheme, also contributing in superannuation fund. I have to see what is the total contribution that my employer is doing. Up to 7,50,000 per annum. If it is below 7,50,000 per annum, apply all the exemptions that you were getting earlier. Take the exemptions, balance will be taxable. As it is, no difference. But if total contribution in all these funds is more than 7,50,000 per annum, whatever excess amount your employer is contributing, that will be taxable to you as a perquisite, and that earlier exemption will not be applicable. So what I can summarize is, now the exemption for these three funds are the respective exemptions that are given in these three sections, or total 7,50,000, whichever is lower. Again, what is the exemption finally now? Whatever exemption you calculated as per 3 sections differently, do the total of that, or 7,50,000 per annum, whichever is lower, balance amount will be taxable. So maximum exemption they kept 7,50,000 per annum. And what they said in addition to this, whatever will be the interest on this contribution, the contribution which is over and above 7,50,000, whatever is the interest, that will also be taxable. For example, my employer is contributing in this year rupees 8 lakh in my recognized provident fund. Rupees 8 lakh. Can I say this is more than 7,50,000 per annum? Yes. So what exemption I will get? Up to 7,50,000. Balance 50,000 will be taxable to me. Now, in this entire year, on this 8 lakh rupees and whatever is the fund available in my RPF, I would be getting total interest. Let's say the fund available in my RPF in the beginning of the year is 30 lakh. In this year, I contributed 8 lakh, my employer also contributed 8 lakh. So total of the fund in the ending of the year will become 46 lakh. On this 46 lakh, can I say I will be getting interest? Now generally, so that interest is also exempt up to a particular limit, that is 9.5% per annum. However, government said this 50,000 employer contribution is taxable, na? So whatever is the interest belonging to this 50,000, that interest should also be taxable. It should not be exempt. So now one thing was pretty clear, that whatever contribution employer is doing over and above 7,50,000 in a year, that excess amount is taxable. But whatever is the interest belonging to that excess contribution, even that is also taxable. But the only question was how to identify how much interest belongs to this 50,000. How much interest belongs to this? Because the total interest that you get is on this 46 lakh, which is opening plus your own contribution plus employer contribution. And from that only on 50,000 rupees, whatever is the interest, that is taxable. And that's why now they have came up with a rule 3B. Rule 3B is issued by ICAI, that is issued by Income Tax Department through notification number that is given in your statutory amendment PDF, number 11 by 2021, dated 5th March 2021. On this date, they brought one new rule in this Income Tax Rules 1962, and that is Rule 3B. It gave a formula. Understand, by looking at this formula, it seems that it is difficult, but it is not. It is very easy. Let me go slowly, step by step, and we'll do one example through which it will be crystal clear. What is Rule 3B? It says that how much will be your taxable interest? It will be the amount of contribution which is taxable during the year. Do divide by 2, so it will be average. Multiply the rate of interest plus, in earlier years also this should have been taxable, na? So how much was taxable up to last year? How much was interest taxable on that up to last year? On that also you would have got interest in this year. So divide by rate of interest. Again, what is the formula? TP is equal to PC divided by 2 into R plus PC1 plus TP1 into R. Now let me tell you, by the way, this amendment of 7,50,000 and the interest component on that and all, Rule 3B, that all is with effect from previous year 2021. So that is applicable for your attempt, and that's why we are looking at this amendment. Whatever is the amount of contribution prior to previous year 2021, that was not taxable. From previous year 2021, this 7,50,000 wala rule is applicable. Now here, what is the meaning of TP in the formula? It is taxable perquisite under section 17 clause 2. That is taxable interest component for the previous year. See, that 50,000 of excess contribution that we already did, that is taxable. Here what TP means, the interest component which is applicable on that excess contribution. What does PC means over here? PC means amount in excess of 7,50,000 as contribution of employer. Please mind well, it is for this year. So in my example, 50,000 was the amount which was in excess of 7,50,000 for this year. So here PC will means 50,000. Divide by 2, multiply by R. R will see later on. What over here PC1 means? PC1 means amount in excess of 7,50,000 as employer contribution in all the years after 1st April 2020 up to starting of the year. What they said, after 1st April 20 up to starting of the previous year. Now you may get confused that sir, for us previous year is 2021. So after 1st April 20 but before starting of the previous year, how it is possible? Not possible. So for previous year 2021, PC1 and TP1 is not there because prior to this year that was not taxable only, na? This rule was not applicable. So sir, why it is there in the formula? Array, for previous year 2021, 21, 22 onwards. So let's say if I am standing in previous year 21, 22, for me something will be there na which was taxable in the last year, that is 2021, before starting of current year. So this PC1 and TP1 is from 21, 22 onwards applicable. It is not applicable for previous year 2021, mind well. For you people, previous year 2021, only this much is the formula. TP is equal to PC by 2 into R, simple. From 21-22 onwards, this remaining part of the formula will be applicable. Obviously, I will be teaching you how this works by taking an example of 21-22 also. But let me tell you, in your exam, they will ask you only up to this half formula because the balance part is not applicable to you people. Similarly, what is TP1? It is the taxable interest component in all the previous year. From 1st April 20 till starting of the previous year, for you it is not applicable. But what is the meaning of R over here? Rate of interest. Average rate of interest. What I said? Average rate of interest. That means interest of the year, what you got on this provident fund, divided by FAVG. That is what formula says. It means interest divided by average of opening and closing balance of all the funds for which you got the interest. Average interest. Now I have written some easy process in the easy words. First of all, you have to identify whether employer contribution in RPF plus NPS plus superannuation fund is exceeding 7,50,000 per annum. If no, then don't think further. No further calculation applicable. If the main contribution is not taxable, why the interest will be taxable? But if this total of this three fund employer contribution is more than 7,50,000 per annum, then yes, that excess amount is taxable. And on that whatever interest component is there, it is also taxable. So now we'll start the process. First we'll identify the word PC. PC means what? Whatever is the contribution over and above 7,50,000, that we already found. Now identify how much total interest is given for this year and decide what is the rate of interest by applying interest divided by average opening and closing balance of the fund. That will be rate of interest. Now based on that, apply the things in the formula and you will get the taxable interest component. I have drafted one example which will be very helpful to understand this entire provision, and if ICI is gonna ask you something on this point which is having very high chances, then definitely it will be surrounded by this kind of example only. Mr. X getting basic salary of rupees 5 lakh per month and 10% DA. So this 10% is what? 10% of basic salary. Tell me how much total salary I am receiving during the year. Can I say 5 lakh plus 10%, that is total 5,50,000 per month. And if I do the yearly calculation, then it will become 66 lakh. My salary for the year is 66 lakh, that is basic plus DA. Now he contributes in his RPF 12% of basic plus DA. So whatever is the total in the year for basic plus DA, of that 12% he contributes in his RPF. So tell me how much he contributes as employee contribution in RPF account. Can I say 66 lakh into 12%, that will be 7,92,000. And what I have written, the similar contribution is done by employer also. So his own contribution, that is employee contribution, is 7,92,000. Employer contribution is also what? 7,92,000. People, are you clear up to now? Okay. Now, opening balance on 1st April 2020, that is opening balance for the previous year in this RPF account is 12 lakh rupees. Closing balance is 30,06,720. See, opening balance I have given 12 lakh. Now, can I say during the year I would have contributed 7,92,000. My employer has also contributed 7,92,000. So, if I do the total 12 lakh plus 7,92,000 plus 7,92,000, it becomes 27,84,000. But how much closing balance I have given? 30,06,720. What it means? It means 2,22,720, that is the balancing figure, is the interest that is credited to your RPF account. Don't you think so? See, salary 66 lakh, my contribution 7,92,000, my employer also contributed 7,92,000. So the balancing figure, that is opening plus my contribution plus employer contribution minus closing balance, that is the total interest that I got, 2,22,720. Okay. Now understand first of all, how much my employer contributed in my RPF? 7,92,000. More than 7,50,000 per annum. So that balance 42,000 is the taxable perquisite. It will be added to my perquisite. This is taxable. 42,000 is taxable. But whatever is the interest component on this 42,000, even that is also taxable. But how to find out how much is the interest on that? For that, let us use the formula. TP is equal to PC divided by 2 into R plus PC1 plus TP1 into R. As I have said in previous year 2021 calculation, this second part will not be applicable. So for us, TP will be what? PC divided by 2 into R. Simple. How much is the PC? PC means current year taxable perquisite. That is 42,000 we already found. Now let us find out R. R means simple, interest amount divided by average of opening and closing balance of the fund. Interest amount we already found, 2,22,720, balancing figure, divide by opening plus closing divided by 2, that will be average balance of RPF. So it will be 12 lakh plus 30,06,720, opening plus closing, divide by 2, that will be average balance, that is what? 21,03,360. Interest divided by average balance. So what is the percentage, effective percentage of interest? 10.59% approx. You can go up to 4 decimals also. It is okay if you go up to 2 decimal. 10.59%. Now there is nothing called PC1 in this case, because up to earlier previous year nothing was taxable. This rule was not operative. There is nothing called TP1, that is interest component was also not taxable. So that's why what will be current year interest component which is taxable? TP is equal to PC divided by 2 into R. PC is what? 42,000 divided by 2 multiply by 10.59%, that is effective rate of interest which we found, which is coming to 2,223.9, approximately 2,224. Means during the year 42,000 rupees of employer contribution is taxable. On that, how much interest is there? 2,224 rupees. Even that is also taxable. So my final taxable perquisite for this will become 42,000 plus 2,224. That will be 44,224 rupees. Are you understanding this, people? Yes or no? Only this much will be asked in your exam. But let me explain you now the full formula. Because from 21-22 it's still applicable. So what's wrong in learning that part? Now let's say in the next previous year, 21-22, what will be opening balance of RPF? What was closing balance? That is 30,06,750. And let's assume closing balance of RPF for 21-22 is 50,49,792. Let's assume employee contribute the same amount 7,92,000, employer contribute the same amount 7,92,000, all the things are same. So how much employer contribution will be taxable in 21-22? Whatever is the excess amount, that will be 42,000, same amount. Now let us find out how much interest component is taxable. The formula says TP is equal to PC by 2 into R plus PC1 plus TP1 into R. Now that will be effective because I am in the year 21-22 onwards. PC is equal to what? Taxable perquisite for this previous year, that is previous year 21-22, amounting to 42,000. Now let us find out interest. Can I say closing balance minus opening balance minus employee contribution minus employer contribution? That will be my interest. So that will be what? 50,49,792 minus 30,06,750 minus 7,92,000 minus 7,92,000 amounting to 4,59,042 rupees. Divide by average balance. How much is the average balance of 21-22? Opening plus closing divided by 2. That is around 40,28,271. So the effective rate of interest for 21-22 will change. It will not be the same. It will be over here 11.3955%. Now let us apply the formula. TP is equal to, before that, what is PC1 now? In 2021 though it was 0 because up to previous year nothing was taxable. Here PC1 will be something. Now I am standing in the year 21-22. Now what I have to see, how much was taxable up to last previous year, up to starting of the previous year. So can I say up to starting of the previous year, but on or after 1st April 20, only one previous year was there, 2021. How much was taxable component of employer contribution in 2021? If you see the question, it was 42,000. So my PC1 over here will be 42,000, which was taxable in previous year 2021 prior to 21-22. And what is TP1? How much interest component was taxable in the last previous year, that is 2021? Can I say we found it by formula 2,224 rupees. Here it is. So what will be TP over here? 42,000 divided by 2, that is PC divided by 2 into R. 42,000, that is of 21-22, divided by 2 into effective rate of interest of 21-22 plus TP1 plus PC1 divided by, PC1 plus TP1 into R. PC1 42,000, TP1 2,224 into effective rate of interest. Just apply the formula. You will get how much interest component is taxable in 21-22, that is 7,432.605, rounded off to 7,433 rupees. But please mind well, in your exam, the question of previous year 2021 will be asked. In that, PC1 and TP1 will not come into the picture because up to last year it was not taxable only. Are you understanding my point? They have also explained the same thing over here entirely. They have also given one example. Let us solve that also. Suppose X Private Limited contributed rupees 8,50,000 during previous year 2021 towards recognized provident fund to the account of Mr. A. So can I say for Mr. A, employer contribution is 8,50,000, which is more than 7,50,000 per annum. So how much will be taxable? 1 lakh rupees. Okay. So that will be PC for my formula, 1 lakh rupees. Now Mr. A had also made an equivalent contribution balance in RPF. That means similarly 8,50,000 contributed by employee also. Now balance as on 1st April 20 was 32 lakh and interest what added is 3,44,250. Here they have given the interest amount. So what will be the closing balance of RPF? Can I say it will be 32 lakh plus 8,50,000 my contribution plus 8,50,000 employer contribution plus interest 3,44,250, closing balance will be 52,44,250. Now, I already came to the conclusion that 1 lakh rupees of employer contribution is taxable. Now what I have to find? How much is interest component belonging to that? So for that what I will do? I will use the formula TP is equal to PC divided by 2 into R plus PC1 plus TP1 into R. Whether for 2021 this point will be applicable? No, because up to last year nothing was taxable, forget that. We are only supposed to focus on PC divided by 2 into R. We are supposed to find TP. PC we already know 1 lakh rupees, that is over and above 750. Divide by 2. The only thing which is pending is multiply by R. What is R? Interest divided by average RPF balance. Interest amount they have already given 3,44,250. Now let us do average balance. 32 lakh plus 52 lakh 44,250 divided by 2. That will be 42 lakh 22,125. What is the interest? 3 lakh 44,250. So what is effective rate of interest? 344 divided by 250 divided by 42 22,125 will be around 8.1535%. That is what given over here also, people. Yes or no? So what I am supposed to do ultimately? 1 lakh divided by 2 into 8.1535%. 50,000 into 8.1535%. My taxable interest over here will be 4077. Oh, it was here only 4077. Are you understanding this, people? Yes or no? So that is the amendment. If you see, it is not that difficult also. One time you understood it, now you will remember for lifetime. But don't forget to do average. Here, while calculating effective rate of interest, the only thing that you may forget in your exam also, and that is to do the average of the balance and then to find out what is effective rate of interest. Don't forget it. And the last point which they have added as an amendment, see, there is a provision in section 139AA. First of all, what is 139AA? You must have learned this section in assessment procedure chapter. Assessment procedure, section 139(1) onwards. In assessment procedure, there is a section 139AA, quoting Aadhaar number. In each and every return of income, in PAN card application, you have to quote your Aadhaar number. And those assessee who are already having permanent account number, they have to link their PAN with Aadhaar number. If you fail to link the same, your PAN number will be made inoperative. There was a provision. Now, timely they are extending this date of making it inoperative. They are extending because still many people are left out and they can't punish many people at once. And that's why up to now the due date was 31st March 2021. That if you will not link your PAN with Aadhaar up to 31st March 21, then after your PAN will be inoperative. Now this date is extended for further 6 months and now the date is 30th June 2021. So if up to 30th June 2021 you are doing linkage, it will be totally okay. After that, we will make it inoperative. Let me tell you, even this date is also extended now. But for you people, what you have to remember? 30th June 21. Because then after what amendment came, not there in your syllabus. So that are 2 statutory updates only. Again, I am saying this. Whatever you have studied in your classroom is totally amended lectures for November 21 students. Whatever lectures we have given to you in your respected batches, in your live batches, everything was amended. Just 2 amendments which are newly incorporated and that I just gave you as the video. Now you are there with the totally amended direct text. Go and prepare well, score well. Thank you so much guys, all the best for your examination.